All right, folks, today we're going to teach you how to ditch the bank and learn these 5 other avenues to skyrocket your money. Why wouldn't I use a bank? According to the Wall Street Journal, not all savings vehicles are created equal. For example, the Federal Deposit Insurance Corporation data shows that the average savings account rate is a mere 0.4%. There are products out there that they deliver returns of more than 5%, with high inflation pinching Americans' wallets. Putting your money in an account where it earns interest can help mitigate loss of purchasing power if it's positioned the right way. As we focus in on leverage, liquidity, and control, folks, stay tuned to the end for a special bonus for you. Number 1, certificates of deposit. It's really best for locking in favorable returns on money earmarked for medium to long-term expenses. Now, here are some of the facts. It's insured up to $250,000 per account type if with an FDIC or NCUA member institution. Number 2, average rate on a 12-month CD is approximately 1.59%, always subject to change. And last part, here's a little bonus, folks. Top fixed annual percentage yield, APY, can be found on depositaccounts.com as 5.65%. Certificates of deposits or CDs provide the predictability of a fixed rate of return. CDs tie up your money until they mature. The upside is that you lock in on favorable yield until the maturity date. Regardless of what happens to interest rates in the interim, CD terms range from as short as a month to 5 years or even more. Financial advisors say that CDs are really, really good if you're saving toward a specific goal, so you know the money's going to be available, such as buying a new car, a house, or even paying for college. Number 2, high yield savings account, optimally used to generate yield on the liquid cash portion of your savings. Key facts: insured up to $250,000 per account type if with FDIC or NCUA member institutions. A little bit of alphabet soup thing going on there. Average savings account rate 0.4% according to the FDIC. And the top APY found on depositaccounts.com is 5.01%. Although the national average saving rate is a mere 0.4%, the best savings accounts today pay up to 10 times that amount or more with the same flexibility as a traditional account. A number of newer primary online banks have in recent years been popping up, offering higher than average interest to attract customers. You should look out for that, folks. It's available and it creates a much better discipline. Number 3, money market funds. Now, think of it this way. If you want to maintain a pool of liquidity inside or part of an investment portfolio, the average 7-day yield of the top 100 money market funds is 4.84%, according to Crane data, which tracks money market fund performance. Purchased through a brokerage account, it's not a bank account, and it's not FDIC insured. A money market fund is a type of a mutual fund that invests in ultra short-term bonds, also called money market mutual funds. You buy these ultra short-term bond funds through a brokerage account. You can open up online. You can do it with your broker, such as Vanguard or Charles Schwab. They are a good place for investors to hold cash so they can move quickly if they want to allocate towards stocks, bonds, or other assets. Now, keep in mind, we're in a higher, in the last 10 years, interest rates are a little bit higher than they've been, obviously. So these yields that you're seeing, they kind of track what's happened currently. So even though they're up here, if interest rates go down, they can go down as well. So keep that in mind as you do the proper planning with your advisor and understand how to utilize these in a way to accomplish your outcome of putting money to work for you in other areas. Number 4, Treasury bonds and notes. Now, think of what it's best for would be fixed income stream without the risk of a default. So here are the key facts. It's backed by the full faith and credit of the U.S. government. Some say that's pretty risky, but I'm just kind of giving you the backdrop. Number 2, purchase through Treasury Direct or secondary market. Minimum purchase amount through Treasury Direct is $100, sold in $100 increments. Current yield on the 2-year Treasury note is roughly 4.5%. On the 10-year note, it's roughly 3.7. On the 30-year, it's roughly 3.9. Go back to 1980, the 30-year was north of 14% interest. Imagine getting 14% interest for 30 years. Anyway, interest income is exempt. Interest income is exempt from state and local taxes. Treasury securities debt instruments issued by the U.S. government are the bedrock of the global financial system and are a safe option for savers looking to diversify their cash portion and generate a steady income stream. Treasury notes or T-notes have maturities ranging from 2 to 10 years. T-bonds or Treasury bonds have maturities of either 20 or 30 years. Either pay interest every 6 months until maturity. At maturity, you receive back the face value of that bond or note. So you put 100 grand into a 30-year note. 30 years later, you get 100 grand back, but every 6 months you get payments throughout that 30-year period. If you have any other questions, feel free to ask in the comments, or in the comments if you want us to do other videos, let us know. Number 5, I-bonds. It's best for long-term inflation protection. Inflation is like a stealth bomber. It erodes your money and you only see the effects afterwards. But here's some key facts. Backed by the full faith and credit of the U.S. government, purchased through Treasury Direct, 30-year maturities, annual purchase limit of $10,000 per person. Interest rate adjusts every 6 months. Current yield is 4.3%. Interest income is exempt from state and local taxes. In an era of high inflation, I-bonds can offer an attractive return combined with low risk. Love it. These debt securities issued by the U.S. government are specifically designed to combat rising prices. The interest rate you earn on an I-bond is composed of 2 parts, a fixed rate, love that, and a variable inflation rate tied to the Consumer Price Index, also known as the CPI. The Treasury Department announces new rates every May 1st and November 1st to reflect the current inflation situation. Bondholders' rates adjust twice yearly depending on when the bond was purchased. Look, if you don't want to take risk and if you're killing it financially, these are good places to store that cash and get that rate of return while you're figuring out what your next move is. So just remember, don't chase that rate of return, be the rate of return. Here's the bonus, folks. I know you've been waiting for it, whole life insurance, but let's not make fun of it. Whole life insurance is the turbocharger. If you put it in the middle of your other investments, you'd be amazed at what happens. Whole life insurance policy can be treated like a personal bank. Yes, it can. Your cash value savings provides guaranteed growth tax deferred, so you don't owe taxes with your saving. And if you borrow whole life insurance cash value through a loan, you could take the money out without owing taxes and reinvest it into other assets. But remember, those other assets, if and how they earn a rate of return, you then put it back into your policy, and that's how you do the velocity of money multiplier and get multiple use of each and every dollar. If you want to learn how to store money into a life insurance policy and not only just overfund it, but leverage it for other investments and have those investments come back and pay the policy so you could become your own bank, go ahead and click that link below. One of the members here at Epic will take you through the success process. I can't thank you enough for being part of the community. Continue to like, subscribe, and share.